So you better get your buy list ready. Today we're going to fill it up with some good stock picks. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. I am super excited about this one. I'm with my co-host Vero. We're going to talk about some stock picking today.
Right. So, Mike, we're already in the last month of the year, which is a great time to look at some of the best stocks for the year to come and also for beyond. Because, investing is not about just 1 year. So, the best thing is you prepared some good surprises for us today. Like, no, listeners, not Alimentation Couche-Tard this time. This is not going to be part of the list. So, already there, we're going to have like some fun.
Man, no Couche-Tard, no National Bank, but we are going to cover the consumer staples and the financial
Right.
services sector, though. Of course, we do have a few classic stocks that we're going to talk about that, yes, I'm not going to surprise you with, but there are a few companies that we don't necessarily cover that much on the show that are not necessarily in my portfolio, but just wanted to highlight a few different companies this time. The goal is still to buy today, but not just for 2026, but for many years to come. And we're going to talk a little bit more today about the narratives, not necessarily the financial metrics. And as usual, those are not buy recommendations. You have to do your due diligence. I mean, you cannot buy a stock just because you heard it on the show. That doesn't make any sense. You don't know the business. You don't know how it works. You may not even understand their business model. You may not even understand what's the risk in it. And we're going to talk about like some smaller plays that did not go well in the financial sector later on today, mostly about that. And I get some question about that. It's like, hey, Mike, what's going on with stock AYZ? And I'm like, yeah, well, I mean, it's unfortunate, but it's not surprising. It's expected to see that's not going well in this specific situation. So you have to understand all of this. So once again, I'm not your broker. And I mean, because I don't charge you for that, you cannot go after me if you're losing money after this show.
All right, so Mike, the first sector we will look at today is financial services. How would you summarize what happened for this sector in 2025?
So first things first, I mean, it was in positive territories, like big shocker here. Better performance on the Canadian sector than in the US in terms of like, yes, it's all up double digit, but the banks, the big banks, they made a huge comeback. So that was like something quite interesting. Scotiabank, CIBC, TD, they just like recovered like there's no tomorrow. They've been like doing better than National Bank. I cannot say that out loud, but still. But yeah, so that was a good year for any shareholders that own any banks, that's for sure. The other thing that's important to mention is, of course, the interest rates on both sides of the border. So the market is craving for interest rate cuts. They got served big time in Canada. It started in 2024, kept on dropping also in 2025. Now with the latest one that happened, I think it's in October, if I remember correctly. Anyways, the Bank of Canada said now it's probably enough. We cut it like several times already. Now the overnight rate is at 225. It was above 4% not too long ago. So pretty deep discount here, which will, of course, fuel the market and will impact banks' net interest income, but will also offer other opportunities. I'm going to discuss that in a second. But just before that, moving on to the Fed on the US side, a few cuts, but not that much, probably not enough for a lot of investors' taste. The market is craving for those interest rate cuts because cheaper interest means that you can spend more money. And if you can spend more money, chances are you're going to do more projects, probably better chances of generating more money. If you borrow, well, it's just like makes it better investment as well. So a few cuts, but not enough. The Fed is kind of stuck because they still see inflation still being strong. It's a bit of a tricky place to be. A lot of politic pressure also to have interest rate cuts. Of course, I mean, all politicians love to see interest rate being lower and then say, hey, it's because of me, which I mean, that's two completely different things. And that comment is good for Canada. It's good for the US. It's good for Italy. It's good for every countries. I think
Right.
politicians are trying to brag a little bit more than what they actually do, but that's just my take on politics, anyways. Overall, the market was up. I mean, no big surprise here. I'm not telling you something you don't know, but that also means that assets under management goes up, even if there is no net inflow. So even if you do not have any new investors coming to your firm to invest, you still have a larger asset under management. So you're going to charge fees on that. So revenue and earnings goes up naturally. So that is good for asset managers. It's good for life insurance companies because they have wealth management divisions. And it's, of course, good with Canadian banks and banks in general. JP Morgan, Goldman Sachs, they're all doing very, very good on the US side as well. The economy is relatively strong. And on top of that, they have the market to back them up. So while we are waiting to see, because I mean, we keep seeing that the consumer is tight on their budget, they're having problems to just like to grow their spending, they kept up with their loans. A few like downsides here, we are at record level for like auto loans and stuff and credit cards debt balance. So maybe we're building up towards something that's going to be ugly later on, but so far the consumer is able to keep it tight. It was not the same story for smaller lenders, though. I saw that a lot in Canada. GoEasy, for example, reported a bad quarter where they had lower earnings per share, higher provision for credit losses. So, kind of like sending a big signal that, guys, the party's over and we're not going to generate as much money. The stock price dropped, I think, by like 18 or 19% on that day. It's a smaller lender, small cap, volatile. Not surprising to see that. I've been warning investors about those kind of companies that used to do very well. They are doing well on prom night. So whenever they see like a sign that fatigue or consumers are getting like a bit tight, then they're going to take a hit. We saw the same thing for Propel Holdings that is using AI. It's a very small cap using AI to underwrite loans. Smart business model, very aggressive in their methodologies, taking a hit right now, of course. So big guys are diversified, smaller guys move fast, but they take a hit whenever there's a concern in the stock market.
But now, Mike, what does the future of financial services look like for 2026? I mean, what makes it attractive now?
That's a crystal ball question. It's going to be up 12% next year, mark my words, or not. I find those experts giving us those targets so funny because
Hmm.
they're just throwing a dart somewhere and wherever it falls in, they're just like, yeah, this is what's going to happen. I do like the financial sector in general. My first boss, when I used to work at National Bank, said, you know what, Mike? Banks are making money when the market is down and they're making money when the market is up. They're always making money because they're the one dealing with the money in the first place. So that's why I love the financial sector so much. Trying to find picks for 2026, but for many years ahead, that was my goal with the selection. We have like 3 selections today. What I tried to do, not for the first one, but the other two, is to select companies that did not thrive that much on the stock market in 2025. So trying to avoid those that are all sunshines and rainbows, but some of them that we have some concerns, and therefore it's probably a good time to look at those that are maybe in a weaker place in terms of price point than others. But still, the point is always to look at a very interesting narrative and a strong dividend triangle. So I'm not going to change or bend my rules here. It's great investment thesis, buy numbers. This is where we start to select some picks.
All right, so let's start with a bank. So we're starting easy, but not National Bank. Instead, you selected Royal Bank, RY.TO, or simply RY. Why is it so, Mike?
Well, National Bank for the win, Team National Bank forever. I'm not changing my mind about that, but Royal Bank come as a close second in my ranking. The thing is, they are everything that National Bank is, but bigger, which is good, especially if you expect that maybe
Mm,
it's not going to be an easy walk in the park, especially because we see the market going up all the time. At one point, there were going to be a correction. So big
right.
guy, diversified, I kind of like that. So I love their size. That gives them more pricing power. more scalability. And I mean, that gives them the ability to swallow HSBC assets like it was just a small snack. It was an appetizer. I kind of like the way, I mean, it was integrated like super smoothly. One thing that I really love about Royal Bank is half of their revenue does not come from classic banking activities. So they are really good in the wealth management market, in capital markets as well. And then they have the other 50% coming from issuing mortgages, commercial loans, save it like opening bank account and stuff. But having this balance between the both sides is really interesting for me. So that's why I like Royal Bank so much.
But then, any risk associated with RBC, Mike?
Yeah, unfortunately, nothing comes free, right? So, because of their size, they have also a pretty big mortgage loan book portfolio. And that portfolio could get hit if we have a housing crisis. We thought we could have one because mortgage rates like started to go up very quickly in 22 and 23. That threat has faded out nicely, so that's good. But if we get into a recession in Canada at one point or another, we're going to have at least a slowdown in issuing more loans. And then some of those loans are going to fall into the provision for credit losses, the famous PCLs. So, got to be careful about that too. So, that's on the one side. The other side is, of course, I love the fact that Royal Bank is well diversified. But the thing is, capital markets are a lot more volatile than having a mortgage book portfolio. So, it can save the day or kill the day sometimes in a quarter. So it goes along with the market. So if the market goes down, it's going to be a rough time and especially a rough
Mm,
comparable because right now we are like 3 years in a row, double digit returns on the stock market. So of course, wealth management and capital markets are doing amazing. But then if you compare an amazing year with a correction, it's going to be down double digit. It would not be surprising at that point that they would say, oh, our net income is down 25%. Nothing alarming once again. It's about understanding the business model. So you are 10, 20, 30% year over year. That's amazing. The year you get a correction, expect double digit drop and it's going to hurt. So you have to be careful
right.
with that.
Okay, so now let's talk about a new one. I mean, I think we've mentioned it before, but it's been a long time. So Jack Henry and Associates. So ticker is, let me get it straight, JKHY. And Jack Henry mixes information technology with financial services, right?
Yeah, so just a shout out to Alain, that is a listener and a member at DSR. It's kind of funny because
Right.
I know him for my previous life, actually. So, and we talk from time to time, and he told me at one point, he's like, Mike, I cannot believe you haven't talked about Jack Henry yet. I mean, dude, it has to be on your list. And it actually ticked all the boxes in sense of it grows steadily. The dividend triangle is literally perfect. So high single to double digit revenue, earnings, dividend, everything is there. They are offering recurring subscription literally because they offer those software projects to help banks manage their clients, process their payments, do cybersecurity, so identify frauds, real-time payments. They also help as banks to move into cloud-based infrastructure. And in the US, you have to remember it's definitely not the same situation as we have in Canada. There are thousands of banks. So every bank needs those systems. Jack Henry is a leader in that. So they get in, they help
Mm,
banks manage their business literally. So they offer critical software that you cannot really get rid of once you install them. And I mean, I worked for a
mm,
bank for 10 years. When something works, they keep it forever, probably even for too long, even though it needs an
right.
update. They don't even do that, but they're going to keep it. So this is kind of like very, very sticky business model. Super easy to see the stable growth there. They can also help with the mergers between like smaller banks and credit unions in the States. They are at the right place between the bank and the client to provide a critical software. So there's a lot of growth coming for them moving forward as well.
Hmm. And I'm just wondering, like a lot of American investors fear investing in banks since the financial crisis. So is that a way to benefit from the growth from banks in the US while like not necessarily investing directly in them?
Yeah, totally. Because at this point, if you have like a bank having a problem like with higher provision for credit losses, they're still gonna pay their software to process
Mm,
their payments and to manage their clients. It's not going to be one of the first thing they're gonna cut. The downside, though, is they may fall into a weaker investment cycle. So do not invest in that kind of technology and not expand with new services because the bulk of Jack Henry's growth is all about offering new services to their clients, so expanding their offer. Well, if you go into an economic slowdown, well, banks are going to be very careful about any dollars spent, probably just going to sit on the existing technology and try to make it through it instead of like spending even more. So that could be a risk. The other thing is, of course, what we have seen is once you build something that is doing very well, expectations are created and then management says yeah, 2026 going to be a little bit weaker. We're talking about growth of like 6-7%, and then the market didn't like that, so that's one of the reasons why the stock price is down. You also have the options of like the threat of having new fintech going after this market. It's
right.
highly lucrative, highly like the whole market is really interesting to get in, so they could face more competitions along the way. And since they serve like smaller players here and there as well, well, this is where fintechs could attract those smaller players and the growth will be slowed down. So those are the
Mm.
major risks for Jack Henry.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
All right, so last but not least for this sector, of course, let's talk about Intact Financial, IFC.TO. Mike, why go for an insurance company?
Well, kind of ironic because Intact Financial has been in our DSR portfolio models since the very beginning, since 2013. And I find myself
Right?
keep forgetting about it. We don't talk about it enough for the great company it is, actually. So, Intact is Canada's largest property and casualty insurer. And it is really important to be the biggest player in the market when you underwrite insurances, mostly because you have more data, you have more scale, and therefore you are in a better place to write good premiums and attract more clients because it's kind of like a
Mm.
commodity. I mean, when I shop around for my car insurance, I don't care that much about the logo on my statement. I care a lot more about the cost I have to pay. So when you have that kind of like pricing power on the other way around, where you are able to price the contract exactly at the right place, not taking too much risk, not taking not enough risk. So that just comes with data and scale. You cannot do that without it. So this is why they are so strong in Canada. And then they, over the years, they made acquisition to expand their business in the US and in UK as well. So they have several growth vectors across doing more business in Canada, but also outside of the country. And now they have integrated AI to even get a higher level of profitability, just leveraging the fact that they have this huge data and now they have more than humans working on it. They have AI that can extract the best out of it to underwrite the best contract.
Okay, but what are the potential risks for Intact Financial?
One thing that is really hard to predict for them are natural disasters, such as like wildfires, for example. That has been a big talk over the past few summers in Canada. So, for example, they recorded 1.5 billions in catastrophe losses in 2024, and in 2025, their guidance was raised during the middle of the year to 1.2 billion. So that's a lot of money. That's a lot of money that you'll have to pay if there are any natural disasters. And on top of that, it's really hard to predict what's going to happen. So they're kind of stuck there. It's kind of like a hazard of doing this kind of business, literally. The other thing is, while they have expansion opportunities in the UK and US, they also faced a lot of competition. They're definitely not the biggest players over there. So it's a little bit harder to grow the business than it is in Canada because they are not the leader at this point. So those are like the two
Mm.
major downsides of Intact at this point.
Okay, so moving on to another sector, consumer staples. What happened for this sector in 2025?
Well, this one is a rare sector that if you have a lot of companies in this one, you're probably not doing that well because it was one of the worst performing sector of the year.
Yeah,
That's kind of
talk
crazy.
me about it, Mike.
Yeah, yeah, I know. I feel your pain. I feel your pain. I mean, Kushtar is part of that as well. So that's why I don't want to talk about it. Joking. But yeah, not doing that well. I mean, we have consumer sentiment going down and down and down throughout 2025. That is an interesting index to follow to see where the money is going to be spent. It's even stronger for consumer discretionary, but it's also valid for consumer staples. Then
Mm.
we all know that consumers are on a tight budget right now. We have inflation hitting them. We have tariff creating uncertainties. A lot of consumer staples are making money overseas or buying or making products outside of North America to sell them in North America. So they're directly targeted by tariffs on one way or another. We fear of an economic slowdown. They are boring. And on top of that, there's no AI. I mean, they're using AI to improve their business, but there's no hype around Procter and
Mm.
Gamble having this new toothbrush that has AI in it that can brush your teeth better. I don't know, I'm just making that up, but you can see that there's no hype here. And in a market that goes up all the time, it's not a sector that is going to be put on the top.
So then, what makes it interesting for stock hunting, Mike?
Well, that's the tricky part, right? Consumer staples, when the market booms, no one cares because they don't move that fast. Nothing is sexy about investing in Clorox. I mean, they're cleaning products, not fun. You want to ignore them, and then when the market drops and there's fears of recession and their panic hits, well, then you feel like you're overpaying because everyone rushed towards those solid company like store of value type of stocks, and then you're finding, well, they don't have that much growth and now I have to pay a premium for that. So you're kind of like always ignoring them for bad reasons. So that's why I wanted to highlight those right now because they will make a very good investment opportunity if we get into a recession, which has been a running joke for like what, 4 years now. But anyways, that's not the point. The point is, if you're looking for protection, that's probably a good place to start.
All right, so among the stocks that you wanted to highlight, we can find Costco. We have mentioned it before on the show, but what makes it interesting in 2026?
Because I like it. No. Well, here's the thing. What's really interesting here is the company continues to perform very well. They have a clear playbook of opening new stores to fuel growth. They're opening, I think, like 30, 40 new stores per year. It's not that much because they want to make
Mm.
sure that they're profitable on almost on day one. So they have this great playbook. They apply it every year and it works perfectly fine. On top of that, more than 90% of their members are renewing their membership every year. This recipe is kind of like perfect. And the problem with this kind of like perfect company with a perfect dividend triangle and a perfect business model is usually pricing, right? You have to pay a
Right.
premium for quality. So it has always been the problem. But the thing that is great right now is the forward PE ratio is about 45. You're going to tell me it's crazy, but it's in line with the 5 years average. So you're now not necessarily paying too much compared to what
Mm.
usually the market is willing to pay for it. Nonetheless, it is priced for perfection. It aims at generating high single digit growth across the board. So revenue, earnings, comparable sales, and the dividend is going to increase, even though it's a really small yield, high dividend growth type of stock. But the fact that finally this year Costco kept on reporting growing earnings, but the stock price did not increase, that makes it attractive for 2026. It's kind of like a rare pause where you can say, oh, I can grab it before it goes crazy again.
We're still waiting for one in Granby, right? I would have my membership card
I
if
mean,
there
there are
was
a
one.
lot of rumors. I think the rumors are confirmed, but I think it's coming up for real now. So I'm very excited. But I mean,
Yay! All right.
I heard that for 10 years. I kind of like, as long as I don't see the sign, and I read articles about that, and they say, yeah, they're coming. They're starting to build in 2026. I'm like, I don't believe you until I'm gonna walk into it. So I
Right.
don't want to create false hope in my mind for this one.
But I mean, you're right. They're going the safe side with their openings because I mean, I have to drive an hour to
Yeah,
like to Costco, which is not
and
gonna
yet you do
gonna
it. That's crazy.
happen. All right, Mike, besides price that you've already mentioned, what are the reasons not to invest in
Well, I cannot stress enough the price first though. If they don't
it?
deliver, if they have no, but it's true, if they have just one bad quarter, I expect the stock to go down by 10-15%, like very
Mm.
fast. So it would not come as a surprise for me. The second thing is they have been slow on developing their e-commerce. Yes, they have a platform and everything, but it's not a big chunk of their business model. It's probably on purpose, but it's kind of annoying to see everyone moving towards e-commerce online and stuff. And then you just like Costco just want to have people comes in, but it works because they have this kind of like treasure hunt feeling where you get there, the products are not always the same, so you can always get a good deal. You don't have that same feeling if you shop online. So I get it, but still they're facing a lot of competition in their field, and everyone else has more focus on e-commerce. So we'll see how it goes. The other latest problem I can see is inflation, labors that is increasing, cost of goods sold. They're paying their employees a lot more than anybody else in the industry. They justify it by keeping them for a longer time, which kind of makes sense as well. But with all costs rising, it will put pressure on margin, and it's still a margin games when you compete with Sam's Club at Walmart, for example, and when you compete against Amazon and other big shop retailers. So it's because it's priced for perfection, they have no room for making any mistakes in their
Mm.
margin, labor costs, and everything else. So you just have to factor that in if you're about to invest in Costco.
All right, so now the next one is kind of a more classic business model of Costco. I'm talking about Lobla, but Mike, I mean, I'm holding shares of Metro. Like, did I pick the wrong one? Like, why do you like it so much?
Not at all. I really like Metro, and I keep talking. I mean, grocery stores in Canada are doing well. Loblaws and Metros are really fine for years, probably decades. Metro has been my favorite one, so nothing to worry about it. I just wanted to talk about Lobla more. It's a similar relationship, and I don't hold any shares of Metro or Loblaws, anyways. But it's a similar relationship than National Bank versus Royal Bank. So Loblaw is a lot
Hmm.
bigger, has a lot more scale than Metro. So when you fear for a recession, you probably want to go for the bigger guys. That's pretty much the reason why. But we could have done the episode on Metro and would have not. That would have not been a disaster either. I love the combination of like grocery store, 70% of the revenues coming from there, 30% from pharmacy. I mean, they operate like all the big brands that you know, Loblaws, No Frills, Shoppers Drug Mart. What I love
Hmm.
though, above and beyond, is how they have built private labels, their own brands like the No Name and President Choice as huge brands. They offer better margin, of course. It's their own labels. It's just very smart marketing that I believe because all other grocery stores are doing the same thing, but it's kind of hard to remember Metro's brand name or IGA's, like for me, because I shop at IGA's. Yes, I see it, but it's not as branded as No Name and President Choice. So I have the feeling that they did a better job there. They also have like a great growth vector with the pharmacy stores because demand for health and wellness products are going to continue to increase. So they should see revenue growing fast from that end as well. And of course, as I mentioned earlier, if you believe that the market's going to go down, well, grocery stores can, I mean, they did incredibly well against inflation. They are a great place to do a safe move that still has good chances of growing over time.
But Mike, you've mentioned it, but groceries have tight margins. Is that like the major risk for Lobla?
Well, the major risk is the combination of like tight margin and lots of competition. I mean, you have Sobeys, you
Mm-hmm.
have Metro, you have Amazon, Walmart, Costco, of course. So you have a bunch of people very interested in selling fresh foods. And even, I mean, Couche-Tard, not to name them, that are modifying their business model to introduce more fresh foods and packaged foods that still going to get into at the smaller level, but get into competition because at one point there's so many like fresh produce that you're going to buy. You're not going to buy more, you're just going to buy at different places. So that makes it a very tough market for growth. And on top of that, you have like labor costs that keeps on going up. And that's why we see all those autonomous cashiers. You just go there, you scan your stuff, and you move on. That has been probably a very good move for all grocery stores to maximize their profit because they have to rely on lower amount of employees to run their stores and it still runs just fine. But yeah, so the margin, competition, labor's costs, definitely going to put some brakes on potential growth. So far, they have done a great job at managing everything, but we'll see about the future.
Finally, you decided to select Casey's General Stores, ticker is CASY, rather than Couche-Tard this year. Why? What's going on?
It's a small Kushtar. That's about it. I mean, I love the business model. It's very similar. For the funny story, Kushtar walked away from a deal, but they could have bought it in 2010. And while they are really good at not overpaying for acquisition, I kind of feel that this one they regretted a little bit. So Casey Store, ironically, the fifth largest pizza chain in the US. So they have
Right.
made this hybrid model between, yes, selling fuel at their gas station, but their convenience stores are not just about snacks and alcohol and cigarettes, but they also sell pizzas and other packaged foods. So that was a great way for them to grow. They are opinion news stores and making acquisitions. So definitely the same model as Kushtar, but the biggest difference here is for 2026, for example, they expect to increase their number of stores by 270, which is about 10% because now they run 2,800 stores. If Kushtar does the same thing, it's 1.5% of the number of their stores. So when they open new stores at Casey's, that will move the needle. Well, for
Mhm.
Kushtar, they need a lot more than 300 stores to make something exciting. And that's why a lot of people were excited about the 7-Eleven deal that likely never going to happen. But that's the problem with Kushtar right now. We are all desperately hoping to see a new big deal that will propel the stock higher because they will grow their revenue and earnings. But that's a bigger challenge than for Casey's because buying 270 stores or opening new ones, pretty much easy for them to run that playbook for a while and keep on growing high single, double digit with this same playbook.
Right. But then what's not to like about it?
Well, on the other side, they have limited places to grow. I mean, because they're going to face Circle K at one point that is owned by Couche-Tard. But jokes aside, because they are smaller, they have like less scalability because the thesis is all about growing and opening new stores or making acquisitions. So if they get into too much competitions, that's going to be a problem. The other thing is fuel could boost your revenue big time, but the margins are going up and down all the time. So that could also be another factor. Couche-Tard is also face that same risk. And finally, because consumers are tight with their budget, they may or may not decide to go to the convenience stores because most of the time you're going to pay a premium for the convenience, of course, but they may just do the extra mile, take a little bit more time, shop around for better deals at the grocery stores or at Costco. So for those reasons, maybe we're going to see a slowdown in the convenience stores industry altogether.
So, Mike, almost every year we do like how to invest in the year that started like in January. By the way, listeners, I'm cutting myself because I just want to make sure that you hit pause and the subscribe button, not to miss that official week in January. But Mike, which quick guidelines should investors keep in mind for the year to come?
Well, it's a new year, but it's not necessarily a new you for the investment side. I mean, you can have like a bunch of great resolutions, but don't fix something that's not broken. However, it is definitely a great time. And I've been repeating this for the past 3 years, but it's still relevant. Great time to clean up. The market is high. Most of your portfolio shows great returns, great profit. Don't take too much bets and just cut down on those risky plays that paid off. Good for you. Cash it in. And then make sure that you're aligned with your investment strategy. So you must define buy and selling rules to avoid that hesitation. Because when the things are starting to get rocky, people starts to panic very quickly. I mean, we had that moment with the Liberation Day in April, right? For like what, for 2 weeks, the market went down by more than 10%. Everybody was like panicking, like there's no tomorrow. And I was like, what's the panic about? I mean, we did shows about this too. And I was like, yeah, well, all right. So that's not a good news, but not going to kill the entire economy. Why would you just focus on like a small blip? Even today, it looks like a small blip. So imagine. But again, if you panic like this, that means that you do not have clear rules. I mean, I was just like, okay, I'm going to check my rules. Oh, all good. Perfect. Move on. So consistency in your investing strategy will get you to your goals. And you cannot have consistency if you do not have clear rules. That's the bulk of it. I think that for the year to come as well, too much debate on what is the best solution to invest. What is the best strategy? Are you an income or a growth investor? Spend less time labeling, use that time to do better planning and do a better strategy. It's going to be a lot better. The best solution doesn't exist is the one, or it exists everywhere, is the one that helps you sleep well at night and reach your financial goals. So don't try to see what worked in 2025 and move it to 2026. There's not a year that is equal from the last year. So do not try to do that. stick with your plan. That's the most important part.
So, Mike, today's ideas were taken from your classic Top Stocks of the Year issue that you do for Dividend Stocks Rock members. But what's the goal of this Top Stock?
It's the tradition. I mean, I started this before DSR. Can you believe it? I think I started this around like 2010. So it's been 15 years at least in the making. That's grown up to just from a simple list of stocks, just ideas, to a complete guide giving you like the overview of the sector, what happened, what will likely going to happen, and just the fact that I love to have a fresh list of stocks by my side at any time. And the reason is quite simple. It's so much easier to sell a stock when you are excited about whatever is on your buy list. So whenever you hesitate because you have a company that is not really aligned with what you want, the metrics are not that strong, but you hold on to it because you want it to recover, or you just tell yourself, oh, I'm going to sell once it's $17. Right now it's at 16.25. It's not 17 yet. I should or should not sell it. I'm not sure. And it's going to be really hard to get out of this cycle. However, if you debate with yourself, it's kind of funny because you just debate with yourself, right? If you sell a stock or not, well, when you have those amazing companies with great business model that are thriving with great metrics and like consistent dividend growth that are on that list, and you haven't pulled the trigger yet because you do not have free money to deploy there, then it's going to give you that additional push to sell the stock that doesn't belong in your portfolio anymore and move towards something that is more aligned with your strategy and with your goal.
So, listeners, we made a booklet of 6 ideas from that list for you to download for free with like more sectors insights and more stocks to dig into than what you've got today. Simply enter your name and email thedividendguyblog.com/topstocks to get yours now. All right, so thanks, Mike, for your generosity. Always much appreciated. Listeners, do not leave without your top 6 stocks booklet. Hit thedividendguyblog.com/topstocks now to download it. For our show notes and related content, visit thedividendguyblog.com/250. And again, never miss an episode. Hit pause and the subscribe button now to get notified. Get the How to Invest week in January, and just leave us a 5-star rating while you're there. That's going to be our gift. Until next week, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.